Welcome to the second video in our series 6 of the video tutorials on technical analysis. In our previous video, we discussed what support and resistance levels are and how we can use them while trading. In this video, we will be covering the use of trend lines for identifying trade opportunities. Trend lines is another basic tool used for conducting technical analysis. It is a diagonal line formed by joining at least two or more data points of an ascending or descending price move. These data points are the subsequent highs or the subsequent lows in the series of peaks and troughs of a price move. We next get on to understanding the characteristics of the trend line. The most basic is the slope of the trend line. Every trend line is characterized by its slope. The slope of a trend line is defined as the change in the y-axis over the change in the x-axis, where y-axis plots the prices of the financial instrument being traded, while the x-axis plots the corresponding time. Therefore, the slope of a trend line is equal to the change in price over the change in time. Now, when the price of the instrument being traded moves towards higher price levels with time, the change in price over time will be positive. In this case, the slope of the trend line will be positive. An uptrend line has a positive slope. Alternatively, when the price of the instrument being traded moves towards lower levels with time, the change in price over time will be negative. Therefore, in this case, the slope of the trend line will be negative. A downtrend line has a negative slope. Let's try to understand this better through the trading platform. Here we have the daily chart for the dollar-yen. To draw trend lines on your active chart, you need to select this icon from the toolbar above. Having done that, click on the first data point of the trend you have identified. As we can see over here, this is a series of ascending peaks and troughs. So I try to draw the trend line from this first data point towards this next data point. The trend line will be drawn. As you can see here, the trend line is joining the lows of the series of ascending peaks and troughs. This is an uptrend line. Here the price of the financial instrument is moving towards higher levels with time. Thus, the slope of this trend line will be positive. Alternatively, in this case here, in the descending price move, we again draw the trend line joining the highs of the series of descending peaks and troughs. This is a downtrend line. Here the price of the financial instrument is moving towards lower price levels with time. Thus, the slope of the trend line, which is the change in price over time, will be negative. Now that we understand the basics of trend lines, we shall examine their use in trading. Trend lines can be used as an uptrend line or a downtrend line, as we just saw. It can be used in the channel formation as well as in the formation of various other chart patterns. The uptrend line is indicative of an upward or ascending price move. These trend lines are formed by joining two or more successive lows of a series of ascending peaks and troughs, as we just observed on the trading platform. Uptrend lines have a positive slope, and these trend lines act as an underlying support as long as the current price of the financial instrument is trading above it. A breach of this trend line from above signals a reversal in price direction towards lower price levels. For the downtrend line is indicative of a descending price move. These trend lines are formed by joining two or more successive highs of a series of descending peaks and troughs. As observed on the trading platform, the downtrend line have a negative slope. These trend lines act as an overhead resistance as long as the current price of the financial instrument is trading below it. A breach of this trend line from below signals a reversal in price direction towards higher price levels. Let's have a look at the trading platform to see how this works. Getting back to our dollar-yen chart that we used before, as you can see, this uptrend line is formed by joining the subsequent lows of an ascending price move. It continues to act as an underlying support. As you can see, the price moved up, peaked at this point, and came down back to this trend line, took support and trended back up towards higher levels, and was back again close to the trend line. At these points, the trend line continued to act as the underlying support. Once the price breached the trend line from above, the price direction reversed towards lower price levels. Similarly, over here, for this downtrend line, the slope is negative, indicative of a descending price move. This downtrend line is acting as the overhead resistance, as we can see that at these points the price tried to break above this trend line but failed to do so. If the price trends up towards this downtrend line and breaks above it, it would signal a reversal in the price direction towards higher price levels. Trend lines are also used in the channel formation. A channel is formed by subsequent peaks and troughs running between two parallel trend lines. Of these two parallel trend lines, one trend line is formed by joining the highs of all the peaks with one another. This is the top trend line. The other trend line is formed by joining the lows of all the troughs with one another. This is at the bottom of the channel. Both the top trend line and the bottom trend line run parallel to one another. The uptrend line acts as the overhead resistance, while the bottom trend line acts as the underlying support. The financial instrument is considered to be trading within this channel. A break of either of these trend lines of the channel is indicative of a reversal in the price direction. When the price breaks above the upper trend line of the channel, it is considered as a buy signal. Prices are expected to move towards higher levels as the price breaks above this upper trend line. Alternatively, when the price breaks below the lower trend line of the channel, it is considered as a sell signal. Prices are expected to move towards lower levels once the price breaks below this bottom or the lower trend line of the channel. Let's get back to the trading platform to understand how this works. Getting back to our dollar-yen chart over the daily time frame, we see over here that this is the top trend line while this is the bottom trend line. Both of them have negative slopes indicating a descending price move. Both these trend lines, that is the top trend line and the bottom trend line, run parallel to one another. The top trend line is formed by joining the subsequent highs of the peaks of this series of peaks and troughs, while the bottom trend line is formed by joining the subsequent lows of this series. The top trend line acts as the overhead resistance, while the bottom trend line acts as the underlying support. As you can see over here, the price tried to break below the bottom trend line towards lower price levels. In this case, this would now act as the overhead resistance. The price once again started trending back up towards higher price levels, breaking above this trend line, which was now acting as the overhead resistance, and trended towards higher price values. Once again, at the current price levels, this top trend line of this channel is acting as the overhead resistance. A break above this top trend line will indicate a price move towards higher price levels for the dollar yen. Please note that this break above either of these trend lines should be by a considerable amount to confirm the reversal in the price direction. These trend lines are also used in the formation of various other chart patterns such as the head and shoulders, triangle formations, wedge formation, double top, double bottom, and many more. We will be covering these chart patterns in the next videos in this series. This is all we will be covering in this tutorial about the trend lines and their uses. Thank you for taking the time to watch this video.